Good morning, dear students. How are you all? Have you joined today? Early morning. Okay. Good morning. Good morning, Stephen. Morning, Karthik, Mamta. Good morning, Anila. Okay. So we were into the chapter of security valuation, wherein we initially covered the valuation for the equity shares, right? By using the dividend discount model, cash flow discounting model, earning based model, relative model, and then we went ahead with the bond valuation part, which was simply present value of the future cash flows. But what was really interesting in bond valuation was the sensitivity of the bond value with respect to the YTM, right? And there we did a bit of mathematics and physics, wherein we said that there was higher error for greater degree, or I can say the degree of error was more when you were looking for a larger change in YTM. Whereas the degree was not that significant when you were looking for smaller changes in YTM. So we've just identified what could be the reason for that. And essentially what we observed was the curvature of the bond. So it was the curvature effect of the bond, due to which we found that there is an error that we observed. And we actually created a chart where the YTM and bond values are plotted, and we found that there was a curvature, whereas modified duration was looking at it as a single line. Okay, so then we added that convexity effect, and we were good enough to match the actual change in the YTM. Okay, after that we did few questions with regards to immunization of the bond. First, we understood what is immunization, why there was a need for immunization. And then we demonstrated a strategy wherein we were very much sure that the immunization strategy actually works in our favor. After that, we went ahead with the next decision, which was to decide whether we should be holding a bond or whether we should be retiring the bond early in view of the changing interest rates. So there we simply calculated by taking the a net present value of the decision. Now, this is the last part pending in our chapter of security valuation. So let's just have a look at those concepts and then few questions. And then after that, we can we'll possibly take a break, and then post break we'll be starting a new topic today, which will be portfolio management. Okay. So now let's first try to look at certain concepts called as the forward rates. Then we'll be doing something called as valuation of warrants. Then something with regards to some of the money market instruments like the T-bills, commercial bills, the valuations of those sort of things. Okay. Now, when we say first let's cover up some money market instruments, the questions based on that, and then we'll look for the forward rates and the term structure. Now, in the money market instruments, you might have heard something called as treasury bills, right? Treasury bills. Have you heard of this term, treasury bills? Yeah. Have you heard of this term called as treasury bills? Yes. Treasury bills. Anytime? I think you might have learned this in your CA Inter also, where in the initial chapters, that is in the sources of finance, this is one of the source by which government raises funds for itself. So these are like short-term instruments which are issued by government for raising funds. Okay. Now these treasury bills are short-term instruments which are used by government to raise funds for the immediate or short-term requirement. And these are like temporary sources of funds for the government, and they don't have any sort of coupon. The peculiarity of this treasury bills is these bills are basically the debt of government. Okay, these are the debt of government issued by RBI. So Reserve Bank of India sells the treasury bills on behalf of the government by way of an auction. Okay, now these are nothing but promissory notes issued by Government of India. Now the tenure of this treasury bills, it can be 14 days, or it can be 28 days, or it can be 91 days, 182, or even 364 days. So maximum 364 days are allotted for this treasury bills, and all these treasury bills are sold by way of auction, right? So they are sold by RBI through auction. So all these treasury bills, which is the government securities, are sold by RBI by way of an auction. So basically what happens in auction is each of these treasury bills are having a face value of let's say certain value. Now that face value is fixed. You take it as 100 or you take it as 1000, but then that security is put up for auction. So people are supposed to be bidding for it. Okay, so the investors are supposed to be bidding for this treasury bill. So let's say face value, if it is 100, investors are supposed to bid for it at what price they are going to get. Now, of course, if the face value is 1000 and let's say tenure for this is, it's a 91 days treasury bill. Okay, so if it's a 91 days treasury bill, so there will be auction that will be undertaken where investors are supposed to bid their prices, bid the amount which they are ready to pay for getting these bonds, for getting these treasury bills. So investors are supposed to be putting up the auction prices. Based on those auction prices, whatever is the price at which all the bonds can be sold, the treasury bills are allotted. Okay, so suppose there is an auction and selling price was decided to be suppose 97, right? So what is going to happen over here in this case? This will be like treasury bills are issued at discount and they are going to be redeemed at par. So treasury bills are issued at discount and they are going to be redeemed at par. So when you say face value 100, on that 100, you're going to get this bond or you're going to get this treasury bill for a value of 97. Okay, and then that will be redeemed at 100. So basically cash flow for an investor, you look at the cash flow that will happen for investor, will be basically on day 0 you have to pay 97, okay? And then on day 91 you will receive 100. That's a simple instrument. There is nothing called as coupon or anything in the treasury bills. Okay, now if I as an investor got this let's say for 97 and I'm going to redeem it at 100 rupees on day 91, can you calculate what is the rate of return that we are earning? Yeah, can you calculate what will be the rate of return that we are earning on this? Suppose today you are paying 97 to get this treasury bill. Then after a few days, that is on day 91, you are going to receive 100 rupees. Can you calculate the rate of return that you as an investor would earn? What would be the rate of return that you as an investor will be earning? Yeah. What will be the rate of return, guys? How do we calculate the rate of return? So rate of return is basically first you need to check what is the interest that you are earning, correct? And what is the principal, right? And then just you need to multiply it by 100 and further multiply it by certain number of days to make it adjusted for the years, right? So we can simply say that it is 365 divided by 91 because this amount is happening, this transaction is happening in 91 days. So if I'll calculate the rate of return or the discounting rate which we have, principal interest is basically 3 rupees on an investment of 97. So you multiply it with 100 and further multiply it by 365 by 91. This will be 3 divided by 97 multiplied by 365 by 91. So you can see that the rate of return that you are earning is 12.41%. Got it, guys? So it's a simple thing. Simple interest, rate of interest computation. You take the interest on the top, principal denominator, and then just convert it into percentage for the year. Okay. So treasury bills are issued by this through auction, and that's how you compute the yield on this treasury bills. Pretty much simple, right, guys? Okay, so let's do one thing. Let's do a question on this treasury bill from our assignment. Yeah, a simple question. Question number 27, guys. Let's try to solve this question 27. RBI sold a 91-day T-bill of face value 100 at a yield of 6%. What was the issue price? Now, here the story is a bit different. We are looking for the calculation of issue price. Okay. So this is our question number 27. Face value is of course 100 and the yield is 6%. So what will be the issue price? Now we want to compute. We've been given a yield of 6%. We have the face value of the T-bill to be 100. Okay, and tenure is 91 days. If it is 91 days, we'll say let the issue price be rupees X, right? So if the issue price is rupees X, we need to know what is the price for it. I mean, what is the rate of return that we are going to earn, right? So rate of return that we are going to earn is already given to us as 6%. We know that yield calculation in case of treasury bill, yield is computed as the interest that you're going to get. Now that interest is nothing but, can I say the total maturity value, which is 100 minus the issue price. So this is the interest that you're earning divided by the price which you're paying, or which is the yield. Okay, and then you multiply it with 365 by 91. Okay, so yield is like 6%. So 6% is equal to, of course, you do a multiplication by 100 also. So this will be simply 100, or I can say this portion is going to remain same. Now, if we solve this, we can essentially get the issue price. So it is like now 6%. You let me just take it as So 6 will be multiplied with this 91x, right? So over here we'll say 91 into x multiplied by 6 should be equal to, right? So 100 minus X, this entire aspect is further multiplied by 365, further multiplied by 100. So this 91, or this entire portion, we can say it is 91 into 6 divided by 365, right? And also we can divide it fully by 365 into 100. So this is what we have on one side, and on the other side you will have like 100 minus X. So X will be equal to, you can say 100 what did it happen? So 91 into 6 divided by 365. Yeah. So this also needs to be multiplied by X equal to. So finally we can say X will be equal to 100. Or let's take all the X on one side, and we can say it is 1 plus this portion into X is equal to 100. So you can say X is equal to 100 divided by this, which is 98.5262, or 98.53 will be the price at which bond will be, or the treasury bill will be issued. So if the government is issuing you treasury bill at a price of 98.53 and it is going to redeem it at a price of 100, at a full value of 100, then we can say you're going to get a return of 6%. Okay. So that is this question number 27, which is pretty easy to calculate the yield. Okay, so then let's go for another concept called as commercial paper. Are we aware of this term, commercial paper, guys? Are we aware of this term, commercial paper? What are these commercial papers, guys? And who issues these commercial papers? Yeah? Who issues this commercial paper? What are commercial papers, guys? These are nothing but, again, short-term bonds or debentures of highly rated corporates. So you can say the blue chip stocks or blue chip companies have got some power to, you take advantage of the debt markets or the fixed income in their variable, in their side, by taking help of commercial paper. So these are like instruments which are issued by these highly rated corporates, by which they will be able to raise money from the money market, right, for a short-term requirement. So any entity, any big corporate, if it is in need of money for shorter duration, like maybe for a year or maybe for half a year, for a quarter, then you generally issue these commercial papers for short-term requirement. Now, these are basically cheap sources of funds and a quick source of funds for them. So these are like having their origin from US and Europe. So it was like in USA in 19th century, the commercial papers were issued by corporates, because all those commercial banks were trying to play a monopoly around, and the corporates were finding it very difficult to issue new security or raise funds from the banks. So then the corporates decided, let's create a market of our own, and they started issuing the commercial papers. Right. So commercial papers are basically instruments which are issued by corporates, and a replica of that is certificate of deposit, which is issued by the banks. Now, what are these commercial papers? So these are again a sort of promissory note. So our commercial papers are unsecured promissory notes, right, which are issued by highly rated corporates. So these are issued by high rated corporates. Now, it's mandatory for the corporates to get themselves credit rating before they issue the commercial papers. Okay. And these are like commercial papers, which are is a promissory note, and of course they are going to have their tenure. So term may range from 7 days to 1 year maximum, because beyond 1 year it becomes a capital market product, and that's not what we have in the capital in the commercial paper. So these are money market instruments. So maximum tenure for which a commercial paper can be issued be again up to 1 year. Now, just like treasury bills, commercial papers, CPs, are issued at discount, and they are going to be redeemed at par. Right? So basically, you as an investor, you're going to earn the differential amount as the interest. Right? So whenever there is a working capital requirement or short-term requirement, commercial papers are issued by the corporates to take advantage of the money market for short-term money needs. Now here again, we can say the calculation of yield happens on a similar lines. So yield is basically the face value minus, you can say, sale value, which is the difference between the this component indicates the amount of interest that you as an investor is earning. So face value minus sale value upon sale value, you multiply it with days upon we are like period of days or months in a year, and then you simply divide it by 365, then you multiply it by 100 to arrive at the yield value. Okay, so that's how we compute the yield, and we're pretty sure how do we calculate the yield now. So let's try to do a question on the application of this valuation of the commercial papers. I think that's question number 29, I suppose. 29. Question number 29, yes. Yeah. So the company, Z Company Limited, issued commercial paper worth 10 crores as per the following details. So date of issue is 16th of January 2019. Date of maturity is 17th of April 2019. Right. So what is the number of days? Number of days that's given as 91 days, because that's going to be the difference between these two dates. Rate of interest that was offered was 12.04%. And then the question is, what was the net amount received by company on issue of the commercial paper? Now, the amount that would be issued by company, which will be obviously after taking into account the discounting part, right? So we can say that rate of interest is 12.04. So let's just try to do it as on these lines, where we have certain parameters as face value is 10 crores. Face value is 10 crores. Tenure is 91 days. Okay. And rate of interest, or what we can say yield, is given to us to be 12.04%. Okay. And what was the net amount received by the company on issue of commercial paper is to be computed. So we'll simply apply this rule, this formula. there will say 12.04 is equal to face value was 12, sorry, 10, minus we want to know what is the sale value, right? So face value is 10 upon sale value divided by sale value should be multiplied by 91 by 365, and then this is further multiplied by 100. Okay. Now we want to get this sale value. So again, doing the same calculation, I can say 12.04 multiplied by 365, right? And then you divide it by 91 and 100. This should be equal to 10 minus sale value upon sale value. Right. So this will be like 12.04 multiplied by 365, right? And then divided by 9100. Yeah, so this is equal to 10 minus the sale value upon the sale value. So now over here, this will be this into sale value is equal to 10 minus sale value, right? So finally we can say that this plus 1 sale value is equal to 10. Finally guys, sale value will be 10 divided by this number. One second, there is some problem. 12.04 into 365 divided by 91 into 100. Okay. So 12.04 multiplied by 365, and then we divide it by 91 into 100, and then we have 10 minus the sale value upon sale value. So this essentially becomes 12.04 multiplied by 365 divided by 91 to 100. Okay, so this is equal to 10 minus the sale value upon sale value. Right. Then we can say that this is 0.4829 into sale value is equal to.
Sir, it is 91 by 365, sir, instead of 365 by 91.
Okay. Yeah.
Then we get the answer as 9.708.
Oh, I read it wrong over here. Right. So it will be 365 divided by 91, like the previous case, because we're going to make it annualized figure. Right. So 365 divided by 91. Yeah. So this calculation will be like into 91 by 365, and here it will be divided by 91. This entire thing divided by 365. Okay, so now we can say it's 1 plus this term into sale value is equal to 10. So the sale value will be 10 divided by this term, it is 9.7085. 9.7086 crores. So this will be the value at which sale value will be there. So we'll be like issuing this commercial paper for 9.7086 7086 crores, right? So we'll be issuing this commercial paper for 9.7086 crores with a face value of course, 10 crores. So for a face value of 10 crores, we have this sale value of 9.7086 crores. So it means if I'm getting this commercial paper for 9.7086 crores, that is essentially yielding me a rate of return of 12.04%. Okay. That's about this commercial paper, guys. Commercial paper. Now, let's go for the next money market instrument, which is called as Repo. Repo, or what we call it as repurchase agreement. Repurchase agreement. We know what is this repurchase agreement. Who issues this repurchase agreement, guys? And I mean, Repo is really linked with, which institute? Which institution?
RBI.
RBI, yes. RBI is using the repurchase transaction instrument, where what is the purpose of Repo? Like we had an MPC meeting of RBI just yesterday. What was the outcome, guys? What was the outcome of RBI MPC meeting yesterday? Did RBI increase the repo rate or decrease the repo rate? Did RBI increase the repo rate or decrease the repo rate? There wasn't any change, right? So no change in repo rates. That was a stand which was taken by the Monetary Policy Committee of RBI. And there, what is the RBI repo rate, by the way, right now?
6.5, sir.
6.5%, yes. So 6.5% is the RBI repo rate right now, where, what does that 6.5% mean? This is the rate at which RBI lends money to the bankers. The rate at which RBI is going to give money to the bankers. So any banker who is in need of funds for short-term purpose, it can go to RBI and simply take money for a rate of 6.5%. But then 6.5% is the rate which RBI is, promising, or that's offering. But then why do we call it as repurchase? Why do we call it as a repurchase? Have you heard of it? I am pretty sure you may be aware of the term repo, but I want to know whether you're aware of the reason why we call it as a repurchase agreement. Do we know why do we call it as a repurchase?
Repo, it controls the flow of money into the capital market.
That is okay, but why is this called as a repurchase? Flow of money is controlled by repo, by SLR, by CRR, that is all there. But why do we call it as a repo? Repo is basically repurchase agreement. So the idea, my question is, why do you say that it is a repurchase?
Sir, I'm not sure, but can I try to answer this question?
Yes, please.
It's because it is mandatory for banks to deposit some of their money with RBI. But when the banks are in need, so RBI lends the same money to the banks at certain interest rate. That is why it is called repurchase agreement.
No, it's not exactly that. Repurchase means now RBI is going to give bankers, RBI is going to give bankers some amount of money, but then it's not something, unsecured money which is given by RBI to the bank. Got it? Because when we are lending money to anyone, we require some amount of security. And if someone is, not having any security, we will generally charge a higher rate of interest. Now, just think of it. How can RBI lend unsecured money at 6.5%? Right? So just at a cheaper money, like just 6.5%, how can a banker get so cheap money from the RBI? So there is a clause, there is a task that is undertaken over here. Repurchase is, it's obviously the rate at which bankers can borrow from RBI, but then they need to give some sort of security. Right now, what is that sort of security? So security is basically the the government securities. So you need to give some amount of government security as a sort of mortgage or as a guarantee, and based on that, RBI will lend you money. But legality wise, how is this really structured? For example, we have RBI on one hand, and we have, let's say, Bank X on the other side. Now, Bank X is in need of money. Bank X approaches RBI and says that, let's say, I need a certain amount of money. RBI says, okay, I'll lend you some amount of money, but then what, you'll have to give some sort of security. To which Bank X says, okay, I have got the the government securities, and I'll give you the government security. So RBI says, okay, let's do one thing. I will accept government security from you, okay, at some price now, but you will have to repurchase. You will have to repurchase the government securities from me on a future date at a higher price. So basically what would happen is Bank X would sell government securities for, let's say, 98 rupees. This is just hypothetical number. And then this is happening on day 0. Then let's say after 180 days, so day 180, Bank X is going to buy back this government security at a price of 99.5, and this is like the repurchase transaction. So Bank X is going to lend money, or not lend money, my bad. Bank X is going to give government security to RBI against a value of 98, and later on, Bank X is going to receive from RBI the government security, and it will have to pay a price of 99.5. So it is like RBI will give on day 0 to Bank X 98, right? And Bank X will have to return to RBI 99.5 on day 180. So what is the interest that is charged by RBI? Can I say 1.5? So that 1.5 is charged for a price for a day, for a total number of days of 180. So there are how many transactions happening in this repurchase agreement, guys? There are 2 transactions which is happening. There are 2 transactions that are happening. One transaction is happening on day 0. This is called as the first leg of the transaction. And then on a future date, you will have the second leg of transaction happening, where RBI returns the government security to the bank for a repayment of the loan along with the accrued interest. Okay, so are we clear? Why do we call it as a repurchase agreement? Correct? So RBI basically enters into an agreement with Bank X that I will buy from you the government securities at a price of 98. After 180 days, you will have to repurchase these government securities for a price of 99.5. Is this clear? Yes. Is the repurchase agreement clear, everyone? Yep. Okay. Then let's apply this with the help of a question, which is question number 30. So today we are done with 27 is done, 29 is done, and now it's time for question 30. Bank A enters into a repo for 14 days with Bank B. So it's basically a repo between 2 banks in 10% Government of India bonds 2028 at 5.65 crores for 8 crore rupees. So the value at which the repo transaction is undertaken is 8 crores. Assuming that clean price, the price that does not have accrued interest, be 99.42. Initial margin will be 2%. And days of accrued interest is 262. You are required to determine the dirty price, repayment at maturity. Okay. So now this particular question asks us to first compute the dirty price. Now dirty price is basically the clean price plus the interest that has accrued over it. So current market price of the bond or the government security is 99.42, and on that there is some interest which is getting accrued. Okay, so this is question number 30, guys. Yeah, so we have to first say there is a clean price which is available in the market. Clean price is basically 99.42. I need to calculate the accrued interest. I need to calculate the accrued interest. Right, so accrued interest. How do we calculate the accrued interest now? Has the bond given us the tenure for which interest has not been paid or interest has accrued? Yes, the bond is providing us with that number. So the bonds, the question says there are accrued interest is for 262 days, guys. So this bond pays let's say coupon or interest once a year, and the payment happens over a period of time every year. Now it has been almost like 260 days where the interest has not been paid. Of course, for this many number of years, for this many number of days, interest will accrue, and the accrued interest will be paid by this accrued interest is going to be paid by, of course, the seller to the buyer. So when you say the price of the bond or price of a debenture, it is the principal value, that is the clean price, plus the accrued interest. Right? You might have heard of this accrued interest when you will be doing investment accounting in your CA intern. Right? So the price at which the bond will be purchased will be, the accrued interest added to it. So accrued interest will be simply computed as, 10%. So 10%, obviously, if it's 99.42, we can assume that the face value is 100. So accrued interest will be 10%, or we can say just rupees 10 multiplied by, what is the number of days? 262, right? So it is 262 divided by 360. So remember, in case of government securities, please take a note of it, guys. In case of government securities, they follow a convention called as 30 by 360. In case of government securities, they by default follow a convention of 30 by 360. Now here the question is stating 360 days in a year. But yes, if you go to RBI website also and see how to compute their guidelines with regards to computation of the accrued interest, it is always 30 by 360. So, government securities always assume that a month comprises of 30 days and the full year comprises of 360 days. Okay, irrespective of whatever be the month days, like if it is March, even though it is 31 days, interest will be counted only for 30 days. If it is February, even if it is 29 or 28 days, interest will be computed for 30 days only. So accrued interest, you can say it is 10 multiplied by 262 divided by 360. So 7.28. Accrued interest is 7.28. So what will be the total, or what we call it as dirty price? Total or dirty price will be 99.42 plus 106.7. So current value of this government debenture or government bond will be 106.7. Okay, so this will be 106.7. Now, first leg of transactions is what we have to compute, and then the second leg of transaction is to be computed. So it says that initial margin is going to be 2%. So its initial margin is going to be 2%, and The repo transaction is for 8 crores. So nominal value of the repo transaction is 8 crores. Okay. Nominal value of repo is 8 crores, right? So if the nominal value is 8 crores, can you tell me what will be the total value of repo? The total value of repo will be, of course, if this is the face value, because the bond has got a face value of 100, it will be like 8 crores divided by 100, right? So 8 crores divided by 100 face value, and then you multiply it with 106.7. 8 crore divided by 100 into 106.7. So you can say 8 crore divided by 100 multiplied by 106.7, which is 8 crore 53 lakh 58 222. This is the total value of repo. But what will be the proceeds? Proceeds in first leg. Proceeds in the first leg of transaction will be after deducting the margin, because it has stated that there is a margin of 2%. So we can say that this amount multiplied by 1 minus 2%. So proceeds from first leg of transaction with this amount multiplied by 98%. So we are going to receive like 83 lakh 65,000. No, sorry, 8 crore 36 lakh 51,058. This is the amount that we are going to get. That is the amount that you are going to receive under the first leg of transaction, right? So you can say that RBI is going to give this amount, which is 8 crore 36 lakh 51,058 to Bank X against receipt of 8 crore principal or 8 crore nominal value of the repo. So against 8 crore face value government securities, against 8 crore government securities, against 8 crore government securities, the RBI is going to transfer the first leg of transaction, which is 8 crore 36 lakh 51,058. Okay. Now, under this, proceeds of first leg transaction. Now, the second leg of transaction will be repayment of it. Now, of course, the repayment will happen after taking into account the interest which has accrued, right? So, interest which has accrued. So, what is the interest payable under repo? So, interest payable under repo will be initial proceeds multiplied by the repo rate, right? So interest payable under repo will be initial proceeds multiplied by a repo rate, right? Again multiplied by number of days divided by 360. So we have the initial proceeds as 8 crore 36 lakh 51,000. That needs to be multiplied by, what is the repo rate? 5.65%. So repo rate is 5.65%, and then further multiplied by number of days. What's the number of days for which this transaction is undertaken? Repo transaction is for 14 days. So that will be multiplied by 14. Okay, so number of days is 14, and then you divide it by 360. This will essentially work out to be into 5.65% into 14 by 360, which is 1,83,800. So what will be the repayment amount in second leg? So in the second leg, it will be like whatever the proceeds you have got in the first leg you will add to it the interest which is payable, right? And that gives us a total amount of 83 lakh, 8 crore 38 lakh 34,858. Right? This will be the amount which will be paid by us in the second leg. So in the second leg, the transaction is done 5.65% to 14 by 360. Yeah. So this will be the amount that will be paid, repayment amount, which we have in the second leg. Okay. Add it. Yeah. This is on this we have 5.65% for 14 by 360. This is the interest, and then the repayment happens like this. So this is how the repo transaction is basically structured. So on day 0, this is the amount, which is 8 crore 36 lakh 51,058 is the amount that is paid, and then the repayment happens after taking into account the accrued interest. Now that accrued interest is computed on this principal for 5.65% for 14 days, and the total amount that you have to pay is just the sum total of these two. Okay, so that's how the repo transactions are typically structured. And why do we call it as repurchase now? That's what is clear in this typical repurchase question. Okay, then let's look at some of the questions that we are left out. Let's look at this question number 28, guys, first. Question 28. Wonderland Limited has excess cash of 20 lakhs, which it wants to invest in short-term marketable securities. So expenses relating to investment will be 50,000. So we have like 20 lakh of excess cash available with us, and we want to invest it. 20 lakhs is to be invested, which it wants to invest in short-term marketable securities. So we want to invest in short-term marketable securities, but expenses are 50,000. Like whatever amount I'm going to invest on that 50,000 will be the expenditure. Securities invested will have an annual yield. So annual return you're going to get 9%. The company seeks your advice as to period of investment so as to earn a pre-tax income of 5%. So if you want to earn an income of 5%, what is the time period for which you need to hold this investment? Okay. And the minimum period for the company to break even its investment over time value of money. So now here the money that you're investing is going to grow every year at 9%. Right? So every year it's going to be growing at 9%. So rate of return on marketable securities rate of return on marketable securities is given to be 9%. Of course, this is per annum figure. Rate of return is 9% per annum. Initial expenses that we need to pay is 50,000, and investment, the investment amount will be 20 lakhs. Investment amount is 20 lakhs. So investment amount is 20 lakhs. Now the first question says, what is the period that you will need to earn a pre-tax income of 5%. So required return for the first question, the return that we
So should
require.
we reduce that 50,000 initial expenses from this 20 lakh?
No, my investment is 20 lakhs. So the cash outflow from my end is 20 lakhs. Right?
Because they were saying it is excess cash where they have is 20 lakh.
Yeah, excess cash is 20 lakh. I will need to invest this 20 lakh. Now, if I'm going to invest 20 lakh and I need some rate of return. So obviously the investment vehicle will reduce 50,000, right? 19 lakh 50,000 will be invested for sure. But then I need a return of 5% on my investment. So what is my investment? My investment is 20 lakh. So I need a return of 1 lakh.
Okay.
So required return is 5%. So 5% means it's going to be 5% of 20 lakhs. So 5% of 20 lakhs simply means we need a return of 1 lakh. Right? So I need a return of 1 lakh. Now required return is 1 lakh. So of course this investment should be actually giving me a return of 1,50,000. Right? This marketable security should be giving me a return of 1,50,000 because out of that 50,000 will be given away as the initial expenditure. So expenditure will be paid out as 50,000 and required return will be the total amount, which is 1 lakh. Okay. So now on an initial investment of 20 lakh, we require a return of 1 lakh. Right. So what is the time period? That is what we want to know. So we'll say, let the time period of investment to earn the required rate of required return be P days, you can say. So let us take it as P days because nothing has been mentioned to be calculated in the time of months. No. So we can take it as P days. So rate of return that we are going to have should be like based on this P days. So, it is going to be 9%, right? It's going to be 9%. And initially I need to spend out that 50,000. So for how many days I'll be able to hold this? So this is simply like 20 lakh into 9%, right? And this is going to be earned for P days. So it is P by 365. This is what you'll be earning on the investment of 20 lakh. But can I say from this, I need to subtract the initial expenses of 50,000 and that should give me a value of 1 lakh. So 20 lakh is invested. On this, I'll be earning like 9%. But whatever is my earning, from that I need to leave away that 50,000 because that is expenditure which I need to make, right? And so I can just solve this and get the value of the P. So if you solve this, what is the value of P that we get, guys? Can you solve it and give me the value of P? It will be like 1 lakh plus 3,000. And that will be like multiplied by 365 divided by 9% into 20 lakhs. So it's like 304.17 days. So if you're going to hold this investment for 304 days, we will be able to recover the 50,000 and additionally we'll be able to earn 1 lakh as the income on this. So basically the investment will be providing me a return of 1,50,000, out of which of course 50,000 would have been spent by me when the investment was made as initial expenses. Okay, that's pretty simple. Now, same way, the second part of the question says the minimum period of the company to break even its investment expenditure over a time value of money. So over a period of time, we want to see in how many months we will be able to break even. Break even means what? What do you mean by break even? Break even means we will be able to recover the initial expenses, right? So we'll say, let the time period to break even be, X, not X, the period of Q days. So now this same equation we can form, and instead of this 1 lakh, I'll take this to be 0. Now solve this and give me the value of Q over here, guys. Give me the value of Q. Yes. What is the value of Q?
$101 days.
This 101 days. Okay. Let me just see. Yeah. That's 101 days. Right. So in 101 days, you will be able to break even the investment, where you will be able to recover your initial expenditure of 50,000. And beyond that, whatever you earn, that will be an income for you. Okay. So that is this question number 28. Okay. So question 28 is done. 28, 29 is done. Let me do maybe a couple of or one more question. Yeah, let's go for this question 16. Let's understand this question number 16, guys. Sam Limited has just paid a dividend of 2 per share. So this 2 per share is basically D0, right? It has just paid a dividend. So this is basically your D0, which is 2 per share, and is expected to grow at 6% per annum after paying dividend. The board declared to take up a project by retaining next 3 annual dividends. So the board is saying that let us retain the next 3 years dividend, right? And let's invest in a particular project. So Sam Limited has just paid a dividend of 2 per share and is expected to grow at 6%. After paying dividend, the board declared to take up the project by retaining next 3 annual dividend. It is expected that project is of same risk as the existing project. So with regards to the operating risk, you can find that project is having the same level of risk. The result of this project will start coming from the 4th year onwards. So the project will start generating profits or cash flow for you from 4th year onwards. Dividends will then be 2.5 per share, and it will grow at 7% per annum. The dividends will be then 2.5 per share, and it will grow at 7% per annum. An investor has 1,000 shares in Sam Limited and wants a receipt of at least 2,000 per annum from this investment. So an investor is having 1,000 shares and it wants a receipt of at least 2,000 per annum from this investment. Show that market value of the share is affected by the decision of the board, and also show as to how the investor can maintain the target receipt from the investment for 3 years and improve income thereafter, given that the cost of capital of the firm is 8%. So the point is, for next 3 years, there's going to be no dividend from the company. And after that, in the 4th year, you'll have a dividend of 2.5, and beyond that it's going to increase every year at 7%. There's an investor which is holding 1,000 shares and it wants a receipt of at least 2,000 per annum. So it wants this receipt or an income of 2,000 per year, because right now you can say 1,000 shares into 2. So it's like 2,000 shares are basically 2,000 is the initial cash flow that he's having. An investor would like to maintain the same level of income or cash flow during the next 3 years also. So the only way to do this is, this company will have to sell, or this person will have to sell certain shares during these 3 years, and then later on keep on receiving the dividends. Okay, so let us say the value of the share at present. So we have like question number 16 over here. Okay, Sam Limited paid a dividend of 2 per share. So currently, value of share at present. What's the value of share at present? It's computed as simply D1 upon K minus G, right? So D1 will be like, currently the price is, currently the dividend was paid as 2 and it was expected to grow at 6%. So this would be like 2 multiplied by 1.06 divided by cost of capital is 8%. It was supposed to grow at 6% every year. So 0.08 minus 0.06. So current market price of the share is 106. So currently the share is trading at a price of 106, guys, right? So this value of the share at present, we say that it is 106. But now, if the board is going to implement the decision that no dividend would be paid, and for the next 4 years, so for the next 4 years there won't, for the next 3 years there won't be any dividend. Now the price in that situation will be definitely different, right? So price of the share in that situation is going to be will be different, because you will be getting a share today on which you're not going to get any dividend, right? So for next 3 years you're not going to get any dividend, but yes, you will be getting the dividend after 3 years, right? So if board decision is implemented, what will be the price of share in year 3? Price of the share in year 3. Can I say it will be dividend in year 4 divided by K minus G? What's the dividend in year 4? Dividend in year 4 is supposed to be 2.5, right? So 2.5, and then the cost of equity will be like 0.08. The growth rate is 0.075. Right. So what will be the price of the share in year 3? Price of the share in year 3 will be 2.5 divided by 0.08 minus 0.075, which is 500. So price of the share, 1 second. What was the growth rate? Growth rate was 7%. Okay. Growth rate was 7%. So that is going to be 250. So price of the share in year 3 is going to be rupees 250, right? Price of the share in year 3 is going to be rupees 250. Now that 250, the market price of the share after 3 years is 250. What will be the market price of the share today? Because in intermediate term, we're not going to have any dividend. So price of share today will be simply present value of T3. So present value of P3 will be like 250 divided by 1.08 raised to 3. So price of share today will be 250 divided by 1.08 raised to 3. So current market price of the share, if this decision is implemented, the market price is going to jump from 106 to 198 in view of the anticipated increase in the earnings and also for a faster growth in the share price. Right? So price of the share today will be 198.46. Now, same way, because the investor over here, it requires a targeted cash flow of 2,000 every year. Right? It requires a targeted cash flow of 2,000 every year. Yes, Nisha?
I'm sorry, there was some network issue. I did not understand why didn't you apply the 7% growth rate to the 2.5% dividend, sir?
That 7% growth rate will happen in 5th year, because 4th year dividend is directly given to us as 2.5.
Okay.
Okay.
Thank you.
So that is already given to us. So that plus 7% will keep on happening after from 5th year onwards.
Okay. Got it.
Okay.
Thank you.
Yeah. So price of the share today will be 198.46, and our investor requires a cash inflow of 2,000 every year. Now, of course, to maintain, since the company is not going to give any dividend, how will the investor maintain that cash flow? How is the investor going to maintain that degree of cash flow? He will have to sell few shares in each of the years. Right? He'll have to sell few shares in each of the years to get this amount of cash flow. Now, to get the number of shares which he is going to sell, we need to calculate the price of the share in each of the years. Right? So we'll say price in year 2. Then I also need to know what is the price in year 1. So price in year 2 will be calculated as what? Price in year 2 will be, can I say price in year 3 divided by 1 plus KE. Right? Because we are taking 3rd year to 2nd year. So we're just going to discount it by 1 year. So price in 3rd year divided by 1.08 will be the price that we are looking at in the 3rd year. Then, in the 2nd year, then price in year 1 will be 2nd year price, and you then divide it by 1 plus KE. Okay, so the 1st year price will be like 2nd year price divided by 1.08, so which is 214.33. So price in year 1 will be 214.33. Right, so we got the prices of each of the shares. Now, what will be the number of shares that you need to sell? Number of shares to be sold by investor to maintain the targeted cash flow every year, or to maintain the targeted cash flow in year 1, 2, and 3. Okay, so what will be the number of shares that we are going to sell? So year 1, you need an amount of 2,000. Right, so 2,000 will be divided by a price of 214.33. So number of shares will be like 2,000 divided by 214.33. We get it as 9.33. So how many shares will have to sell? How many shares will he have to sell? Of course, he cannot sell partial shares. And if he sells 9 shares, he will not be able to get 2,000. So anything above 9, obviously, he'll have to sell 10 shares. Right? Then in year 2, how many shares will he be required to sell? 2000 divided by 231.48. So that amounts to 8.644, or so that makes us like 9 shares. Okay, and then in year 3, what will be the number of shares which we'll have to sell? It will be 2000 divided by third year share price is 250. So that will be like
8 shares.
exact 8 shares. Exact 8 shares. Right? So how many shares have it sold in total? Total number of shares which has been sold is like 10 plus 9 plus 8. So 27 shares he would have already sold, right? So what is the number of shares he would be, having? Because the question says, also show how the investor can maintain its target investment and improve income thereafter given the cost of capital is 8%. Okay. So total shares left by or shares remaining with the investor. What are the shares that are remaining with investor? Originally, how many shares he had? 1000 shares. So out of 1000, 27 has been sold by him. So we still have like 973 shares. Now, what will be his dividend income? Dividend income in year 4, it will be of course 973 multiplied by 2.5 per share. So that's like 973 multiplied by 2.5. This is 2432. So earlier you were like targeting for 2000 rupees. Now, because of the investment, because of the growth in the investment portfolio of the company, you will be able to get a dividend of 2432.5 every year. Okay. So 2432.5 every year is the dividend income that we have. So obviously he'll be able to maintain a higher rate of return on his investment. Okay. So that's this question number 16. Okay, let's do this question 11 first. Let's cover up this question 11 now. Shares of Voyage Limited are being quoted at a price earning ratio of 8 times. Okay, so we have a P ratio of 8 times. Okay, so this P ratio is going to be used maybe as cost of capital. Let's see. The company retains 5 per share, which is 45% of its earnings per share. So retained earnings is 5 rupee, which is equal to 45% of its earnings per share. You're required to compute the cost of equity to the company if the market expects a growth rate of 15% per annum. If the anticipated growth rate is 16% per annum, calculate the indicative market price with the same cost of capital. If the company's cost of capital is 20% and anticipated growth rate is 19%, calculate the market price per share. Okay, so these are being quoted at a price to earning ratio of 8 times. So currently we have a PE of 8. The company retains 5 per share, which is 45% of earnings per share. So we have like retained earnings. So retained earnings are 5 rupees, sorry. Retained earnings are 5 rupees. So we can get the earnings per share will be 5 divided by 45%. So this is 11.11 is your earnings per share. And obviously that will give us the dividend per share number, which will be 11.11 minus 5. So that's like 11.11 minus 5, which is 6.11. Okay, so dividend per share is 6.11. So P ratio is 8. Now the cost of equity of the company, if the market price is expected to grow at 15%. So now what will be the cost of equity? For that, we know the EPS number and we know the P ratio. So what will be the market price of the share? Market price, or you can say P0 is EPS multiplied by P ratio. So EPS is 11.11 into a P ratio of 8, which is 88.89. Market price per share is 88.89. Okay, market price per share is 88.89. And then after that, market price per share has been derived. We can calculate the cost of equity as simply D1 upon KE plus the growth. So D1 upon P0. D1 upon P0 plus the growth. So KE can be computed as, what is the dividend growth? The company retains 45%. Okay, the cost of equity, the market price is going to grow at 15%. Now again, this wording that we say from the question, it's like dividend is 5 and growth rate is 15%. So we need to know what is the cost of equity. So cost of equity is D1 upon P0. Now we generally take D1 over here. The numbers that we have, it retains 45%. So we take into account that this is possibly the next year dividend. We can also alternatively give an assumption that this is what the dividend was in the previous year, and you can add the growth element to that also. Okay, so I'm just taking this as the next year dividend. So D1 upon a P0. On that, we will add. On that, we will add a growth rate of 15%, which is 0.15. So we can say cost of equity will work out to be 6.11 plus 0.15 yes. So 21.875 or 21.88% is the cost of equity. 21.88% is the cost of equity. Then second is, if the anticipated growth rate is 16%, calculate the indicative market price with the same cost of capital. So now with this same cost of capital, we want to know what is the market price. So we know P0 is D1 upon K minus G. Now again over here, we are assuming that the D1 to be 6.11 and of course the K is 21.88. So it will be like 0.2188 minus 0.0.
Sir, can you explain why we are taking 6.11? Because it was today which it is giving.
It is not stated. It is not stated to be today's. The company retains has been given. So company has retained this and 45%, which is 5 rupees. So 6.11 is left with the company for distribution. So we are assuming that this 6.11 will be distributed on a future date or after a year. Alternatively, you can also give an assumption and say that this 6.11 is belonging to the next year. Both ways are correct because of the sort of ambiguity in the question that we have.
Okay.
Okay. So it is like 0.2188 minus growth rate of 16%. Okay, so 0.16. So if that is the case, then it is 6.11 divided by 0.2188 minus 0.16, which is 104.93. Yeah. So that's the price for the second scenario. Now the third is, if the company's cost of capital is 20% and anticipated growth rate is 19%, calculate the market price per share. So it's a totally different scenario. Again, we can say this particular question. So we have like D1 we are taking, as I said, I'm assuming it to be of the next year. So 6.11 divided by KE is 20%, so 0.2 minus growth rate is 19, so 0.19. So we can say P0 is 0.01, 611 per share. That's this question number 11, guys. Question number 11 price. Now we are left with like few questions in between, which is 12, 14, and 15. So these three are the questions which I would like to give you as homework. Okay, you can try these questions at your own, and you can get the solution to these questions from the study material itself. Okay, and if you find that this same question number 12 is from study material, 14 and 15 both are from study material, you can try them, and in case if you have any doubts with them, then you can definitely bring it up to me in the next session.
Bandhuji,
Yes, sir.
yes, the student has asked that it has not been mentioned in the question number 11 that the company is paying that much of dividend. Okay, so of course we are assuming, but there is no need to give any note. It is presumed in this question.
Yeah, that's what I told them this.
Actually, in our examination, generally there is no. Sometimes, if ambiguity is there, pure ambiguity is there, then we can give a note. Otherwise, we should give any. We should avoid to give any note type of thing.
Okay.
Yeah. So it is assumed, because if the company is retaining 5 rupee, so it is always likely that the company cannot keep the excess cash with them. They have to pay out in some form.
Correct.
Okay, because balance sheet will not be match. Okay, balance sheet will not be matched because this amount will be in the reserve and surplus. Okay, then where will it go? We cannot show it as the other form of liability. Of course, it will either go for buyback or either dividend.
Correct.
Okay. Okay. Thank you.
Okay. So, so question 12, 13, 12, 14, and 15, I would like to give you as homework. You can try it. The solutions are obviously there on our study material itself. In case you are stuck or you're finding any problem in them, you can bring it to me in the next session, which is possibly on Monday. So that session, if there is any issue, we can discuss that. Right now, let's take a break, and post break, guys, we'll be starting with a new topic, which is portfolio management. Okay, so we'll be starting with the topic of portfolio management, which will continue for the next sessions. Okay, so let's take a break now, guys. Once again, good morning, everyone. Okay, so we'll get started with the next topic. Yeah, so next topic for our discussion is the topic of portfolio management. Again, a very interesting topic and a brand new topic also, because we'll be learning this topic or the concept of portfolio management for the first time. So let's get started with the introduction. We all there? Okay. So the most important principle or fundamental of finance, or you talk of most important aspect of finance is undertaking valuation of assets and liabilities, because based on the value only you're going to decide whether a particular asset will be acquired or that particular asset will be left out. So the most important aspect of this finance domain is the valuation part. One second, guys. Let me just save this. Yes. Yeah. So as I said, the most important aspect is undertaking valuation of assets and liabilities, because based on the calculated values, based on the intrinsic value, we take a call whether a particular asset or whether a particular liability needs to be taken or needs to be sold off. So that decision depends on what's the intrinsic value and what is the value that is available in the market for us to invest, right? So first thing, important part that I said is valuation. Determining value of any asset. It is simply present value of future cash flows, right? Now, how do we determine the present value of the future cash flows? How do we determine the present value of future cash flows? We need two things. We need two things to work on the present value of future cash flows. First would be like estimating the future cash flows. Now, future cash flows for a debenture, for a bond, it is quite fixed. We know what it is. But for a shares, it's quite difficult. We know that you can assume that dividends are going to grow at a particular rate. You can calculate the free cash flow. You can look into accounts where the company is investing, look into the projects where the company is investing. So you need to do some sort of analysis with regards to the company's projects, company's investment, and the cash flows that you're generating from those companies or from those projects. Now that is a separate story. How do we go about looking at the future cash flows? But the most important part is, we know that it is present value of future cash flows. We need the rate of discounting, right? So the question is how to determine required rate of return on an asset. How do you determine what is the rate of return that you need on an asset? How do you determine what's the rate of return that you need on an asset? Do you need the same rate of return on all the types of assets? Of course, no. Do we need the same rate of return on all assets? No, because every asset is different. And so our required rate of return for every asset class is going to be different. Now, what makes the assets different? Can I say the only important point of distinction between the asset is the risk involved in that asset. Risk in a government security is almost nil. Risk in a secured debentures is there to some extent. Unsecured debentures have got even more greater risk. Equity shares have got obviously even more higher level of risk, right? Now, even in equity shares also, every company is having a different degree of risk, right? So the idea is, we know required return depends on the risk of the asset, right? And we follow the simple principle. What's the simple principle? High risk asset will be valued using higher cost of, or I can say using higher discounting rate. So required rate of return actually depends on the risk of asset. And of course, if it's a high risk asset, I need to discount using at a higher rate of return. That is pretty much sure about it, right? That is what we are really sure about it. That required rate of return depends on the risk of the asset. And as the risk increases, the rate of discounting or rate of return on a particular asset also increases. Okay. Now, the question again arises, how to measure risk in an asset, right? This is the question that we have, how to measure the risk in an asset. Secondly, for a given level of risk, what should be the required rate of return, right? So we are going to look for, how do we measure the risk of an asset? Like, let's say risk of a particular equity share, risk of a particular debenture, risk of particular, let's say bank FD. So any asset class, we want to know what is the risk in it. Second thing, for a given level of risk. Now, suppose I give you some metric as risk. Now, for that given level of risk, how much is the rate of return that you need? That's what we want this. That's what we want to know. What's the required rate of return? So two things we are going to answer in this particular topic. First is how to measure the risk. Second is, at a given level of risk, what should be your required rate of return? Now, there have been a lot of research happening on these two questions since almost, you can say, 1940s or 1950s for that case. So it's like almost 80 years back. So this subject is, has been developing. Portfolio management is a subject altogether, even though we are going to taking it as a topic in our SFM, in our AFM, my bad. Then, but this topic is a subject in itself on which there have been thousands of research done, and it is still evolving. It is still subject to some debates, subject to certain clarifications. It is still developing over a period of time. Okay, so that development is still happening over a period of time. But this is what has been developed since 1940s. And we are going to cover quite a few of those concepts. And these concepts have been some of them have been Nobel Prize winning theories. Right? So Nobel Prize winning theories or concepts are which we are going to discuss, where we are simply trying to answer two questions. One is, how do you measure the risk of an asset? Second is, for a given level of risk, suppose you measure the risk. After you have determined what is the level of risk, what is the rate of return that you would be requiring? Right? So these are the two questions that we are going to cover. Apart from this, we will be also looking for how to create a portfolio of securities. How to create a portfolio of securities. Now, what will be my objective when I'm creating the portfolio of security? My objective will be, obviously, you would say that I would like to minimize the risk and I would like to maximize the return. But understand, guys, both the things are not possible. You cannot get 50% return at 0% risk. Is it possible to get 50% return at 0% risk? No. You need to keep one of them constant and then try to work out for what should be the resultant impact. Okay. So how to create a portfolio of securities with the two objectives. One is maximize return at given level of risk, or I cannot say given level, but we can say maximize return at acceptable level of risk, and the other is minimize, or you can say minimize risk for a required level of return. So you'll have to fix either of it. Either you'll have to fix your risk that, okay, this is the maximum risk I can take. Now for this level of risk, what is the return possible? And then second is you have to minimize the risk for a required level of return. Like say you want to earn a return of, let's say, 20%. So what is the minimum risk possible with which I can earn this required level of return? So we are going to create a portfolio of securities, and this portfolio is supposed to be the optimum portfolio. So as per our investment objective, we'll have the strategies to create optimum portfolio. So optimum portfolio means meeting the targets of risk and the return. Okay. So in this particular topic, we are going to learn, the roadmap that I can set for this topic now is what we are going to learn. First is measuring risk and return of securities. Second is measuring the risk and return of portfolio of securities. Right? Portfolio of securities using something called as Harry Markowitz model. So Nobel Prize winning financial economist, Mr. Harry Markowitz, we are going to look at the model which we have stated of calculating the risk and return of portfolio of securities. So measuring risk and return of portfolio of securities using the Harry Markowitz model. Third is understanding utility and portfolio matching, and understanding the utility of an investor, understanding utility and allocation of or assignment of portfolio to investors, or you can say to investors' utility. And fourth is, once you have this Harry Markowitz model coming up, then we are going to discuss something called as capital allocation line. Then we will look at what is capital market line. We are going to cover the securities market line, which is also called as CAPM, which is a capital asset pricing model, right? Then after that we have Sharpe's single index model. Then next is arbitrage pricing model. Right, so sharp single index model, arbitrage pricing model, right? And some sort of performance. The last part is portfolio performance measures. So let's say if you have created a portfolio, how do we determine how well our portfolio has performed? So portfolio performance measures. Okay, so this is a roadmap of our entire topic. These are the things that we are going to cover up. Okay, then let's go for the discussion about the first part. How do we measure the risk and return of a security? Let me make it, simple by taking up, the question from the assignment. So there are multiple ways of understanding the risk and return. One of the prominent ways is to calculate the risk using the term of standard deviation. Okay. Now, let me just take you, like, for example, the current market price of the share. Current market price of the share is, suppose, 100, right? Now, of course, going ahead in future, we may observe some changes in the market prices, right? So that we can create some sort of assignment part. Again, we can create some sort of assignment of values with multiple probabilities. Okay. So, for example, let's look at this typical question 1, and then we'll take up some more examples to understand it. The current market price of the stock is 120. So, current market price is 120, and it pays no dividend. So, there's no payment of dividend. Possible prices that the stock might sell, possible prices at which the stock might sell at the end of the year with respective probabilities are. So prices are like 115, 120, 125, and the respective probabilities are given. So we have the price and probability. So price can be ranging from 115, right? And it can go all the way up to 140. So 115, 120, 125, 130, 135, and 140. So these are the possible prices that we may observe at the end of the year. So next year, upcoming year, what is the possible price that we can see? Currently, it is trading at 120. It may fall down to 115. It may become 120, or it may be 125, 130, 135, or maximum 140. And the probabilities are assigned. So this has got a probability of 0.1. Then we have got a probability of 0.1. Then it is 0.2. Then it is 0.3. Then it is 0.2. And finally, it is 0.1. So we know that the possible values or possible prices of the share are these ones, which is, possible prices are these ones, and with the respective probabilities. Now, can you calculate the likely returns which you as an investor will earn if you're going to buy this share today at a price of 120? So if you're going to buy this share at a price of 120 today, what is the likely return which you can earn? What's the likely return? Of course, return will be measured in percentage, guys. What will be the likely return you can set? Yeah. So return can be computed simply by taking the difference between the price expected next year minus the price that we have right now divided by the price that we have right now. And of course, you need to multiply this by 100. So basically, when you're calculating the return can be computed as P1 minus P0 plus, if you're having any sort of dividend in the upcoming year, that divided by the P0 into 100. Now, since we don't have any sort of dividend over here, we have not considered that. Had it been, a case that we have got some dividend also, then we would have definitely added it in our calculation. So I've just taken a difference between the expected price in the next year minus the current market price divided by the current market price, and then to make it in percentage, you multiply it by 100. So we have this as 4.17%. Then the price for the next year will be on the similar lines. 120 is the expected price with this scenario. So we have got a scenario, second scenario, that the price may become 120. So if the price can become 120 and the current price is 120, of course, the rate of return that we are earning is simply 0, because there's no increase in value. And then when we look at the other numbers, we can simply calculate the rate of return using the same formula for the other scenarios also. Okay, so the other scenarios are giving me return numbers as 4.17%, 8.33%, 12.5%, and 16.67%. Now, if I ask you, these are the possible returns that you can get from this particular share. So current market price is 120, and the share prices go all the way from 115 to 140 in the next year. So if I ask you, what is your expected rate of return from this share? How do we calculate the expected rate of return? Expected rate of return. Expected rate of returns. How do you calculate the expected rate of return? Expected rate of return is simply going to be summation of probability into return. Expected rate of return will be summation of probability into rate of return. So this is simply probability into the return. Probability multiplied by return. And then we drag it. We take a sum of it, which is 7.0833. So the rate of return that we expect from this security is 7.083%, or let me keep it up to 2 decimal only. Yeah, 7.08% is the expected rate of return from this security. Right? Because we can get like 4.17% negative return with a probability of 0.1. We can get a 0 rate of return with a probability of 0.1. We can get a rate of return of 4.17 with a probability of 0.2 and a rate of 8.33 with a probability of 0.3. So the expected rate of return is 7.08. But is this expected rate of return a sure and certain number, or is it subject to fluctuation? Is this rate of return a sure and certain number, or is this subject to fluctuation? Of course, it is subject to some sort of fluctuation, right? So it is subject to some sort of fluctuation. There are possibilities that the values may, the rate of return may differ from this. And this is what we observe also. Rate of return, on an average, it is 7.08. But the value may fall up to minus 4.17, and it may even go up to 16.67. So how do we measure that degree of fluctuation or degree of deviation or degree of variation? Can I say we simply calculate something called as standard deviation. We have already done that in the chapter of advanced capital budgeting. So this is our expected return. This is our expected return. Now we have to compute the other aspects, which is risk of the security, because risk of the security is simply measured by standard deviation. Because the greater the degree of fluctuation, greater is the extent of risk that you are facing. So higher the degree of fluctuation, higher will be the degree of fluctuation. And so the degree of fluctuation or deviation will be measured by standard deviation. So standard deviation, we know what's the formula for standard deviation. How do we calculate the standard deviation? Standard deviation is simply square root of summation of probability into return minus expected return square. Okay, so that is simply square root of probability into return minus expected rate of return. So we know that returns are ranging from 4.17 to 16.67, but we want to compute the standard deviation. So when we want to compute the standard deviation, we need to do this calculation. So we already have the numbers of return. So I need to just do return minus expected return. So return minus the expected return is 7.08%. Okay. And once we have calculated that, return minus expected rate of return, I don't have to take the total of this. I need to multiply this square with probability. So see, we can simply say probability into return minus expected return, right? And we can say it is square. Probability into return minus expected return square. So first what we will do is return minus expected return, which is the deviation, we'll square it, right? We'll square it and then multiply it with the probability number. So this are the values that we get for probabilities, the deviation numbers. And then we take, of course, the sum of it. So 34.90 is the probability into return minus expected return, the whole square. Okay, this is what this concept is already covered in our advanced capital budgeting class. So I've already given you the logic why we are doing this subtraction, why we are squaring it, and then of course the square root happening. So standard deviation or the risk of a security will be measured simply as square root of probability into return minus expected return square. So I'll simply take the square root of 34.90, which is having a standard deviation of 5.91. Okay, now of course these are percentage terms. So expected return is also 7.08% and standard deviation is also 5.91%. Right? So one of the primitive measures of risk of a security is standard deviation, and it is still used even today in most of the cases. Of course, it is standard deviation, along with it, it is complemented with other measures also. But yes, standard deviation is a very basic and a very simple measure to evaluate the risk of a security, and that is used even widely today. Okay, so this security, we say we expect the rate of return to be 7.08%, and it may be subject to a standard deviation of 5.91%. Okay, so that's how we measure the risk and the return of a typical security. Okay, now on the similar lines, we'll have look at this question number 2, guys. Question 2, one second. We'll take one more thing. This was a case where we had the past probabilities given to us, and we were supposed to calculate the risk and the standard deviation. Right. So this was our question number 1, which we discussed on the basis of risk and return. Second is we'll discuss about what if we don't have the probability scenarios given to us, but we have like not the probability scenarios, but we have let's say the past data available to us. So for example, we have year and price of the share given to us, and also let's say dividend declared in that particular year. So we have like, let's say in the 0th year, first year, second year, third year, fourth year. Starting year, it was a price of, let's say, 100. First year, the price became 103. Second year, the price became 106. Third year, the price became, let's say, 102. And then, let's say the price has risen to 110. Now, dividend point of view, in the first year, let's say the company has paid a dividend of 5 rupees. In the second year, suppose the company has paid a dividend of 6. Third year, let's say the dividend was again 5, and the fourth year you have a dividend of 4 rupees. Right? So these are the amount of dividend that we have. Now, how do we calculate the expected return and the risk in this type of data? Like if we have the historical data, the past data available to us, if we have the historical or past data available to us where we know the amount of price and we know the number, the price and the dividend, then how do we calculate the expected return and the risk? So for that, we need to first compute the return, which is the historical rate of returns that we have earned. So like in first year, what's the rate of return that we have earned? 103 minus 100. Can I simply divide it by 100? Can I do this calculation? The return that we have earned in the first year, can I say it is price in year 1 minus price in year 0 divided by price in year 0? Is this correct? Or do you see something missing in this formula?
Dividend, sir.
Dividend, yes. We need to add the dividend also. We just can't be focusing only on the prices because we are earning 5 dividend in the first year also. In the first year, we got the dividend also. So the rate of return is basically 8%. And of course, I need to multiply this with 100 to make it a percentage terms. Okay, so 8% is the rate of return that we are getting. Same way, what will be the rate of return in the second year? Can you calculate and tell me? What will be the rate of return in the second year? Rate of return that we are earning in the second year. Can I say it will be 8.74 because now the rate of return that you are earning will be like 106 minus 103 because first year it was priced at 103. Now it is priced at 106. So the increase in price is 3 rupees only. 8% was the return that we earned in the first year. In the second year, of course, the return will be the difference between the second year price and the first year price. And then you add the dividend divided by the previous year price. Same way, I can get the returns for all the subsequent years. Okay, these are the likely rates. These are the historical returns. Now, we haven't assigned any probability over here. Please take a note of it, students. This particular example and the previous numerical is different. There we had the current market price, right? There we had the current market price and we wanted to know what is the likely price in the future. But here we have the past data available with us and on the basis of that we are computing the return. Now here if I ask you, what is your expected rate of return? What will be the expected rate of return? How do we calculate the expected rate of return in this type of scenario, guys? How will you expect? What will be your expected return? Can I say simply take the average? Right? We can simply take the average of all these returns. Now, of course, to take the average, we need the total. So total is 29.45. The expected return will be simply average of historical returns. So average of historical returns will be 29.45 divided by 4. This is 29.45 divided by 4, which is 7.36. 7.36, of course, it's percentage. 7.36% is the expected rate of return. Right? This is the expected rate of return. So in case of historical data, it's going to be simply average of the historical returns. Now, how do we measure the risk in this security. How do we measure the risk in this security, guys? Tell me. Yeah, how do we measure the risk? Same standard deviation, guys. We have to compute the same thing by calculating the standard deviation. So standard deviation of returns is the measure of risk. Now, to calculate the standard deviation over here, the formula that we are going to use, it's a bit different over here. The formula for standard deviation is again square root of, but now it is summation of x square upon n minus x bar the whole square. Or if you talk in terms of returns, we can say it is summation of return square upon n minus whatever is our expected return, we take a square of it. Okay, so this is simply going to be, we need to compute one more column over here, which will be pertaining to the returns. So if this is R, we will definitely need return square. So return squared will be the return multiplied by itself or the square term. And then we take a summation of it. Okay, so the standard deviation will be computed using this number. So that's going to be square root of, like, let me just write it and solve it. So this is going to be square root of summation R square is 279.65. Yeah, so that is 279.65 divided by 4 minus 7.36 square, and this entire thing will be placed inside the square root. So if you solve it, we can get the answer as 279.65 divided by 4 minus 7.36 square. So the standard deviation will work out to be over here 3.96, again measured in percentage terms. This is measured in percentage terms. So that's the standard deviation of return which we have, which is 3.96%. Okay, so that's how we compute the expected return and standard deviation. To summarize, I can say expected return of a security if we are having a historical data. So if you're looking for historical data, the expected return so if it is to be computed, the expected return will be, I don't know what's the problem with this, guys. Yeah. So expected rate of return, if it is a probability data, then it is simply summation of probability into return. And if it is a historical data, then you take simply summation of returns divided by n. When it comes to standard deviation of the returns, it is square root of summation of p into R minus or return minus expected return square. If it is historical data, then we can calculate it as summation R square upon N minus the expected return square. Okay, these are the four formulae that we have covered till now. Okay, now let me just take up maybe some question. Yeah. Now let me just take up with a case where we have suppose two securities available with us. Okay, so let me take a random case where we are looking for two securities and we'll be creating a portfolio, and we would like to know what is the portfolio risk and the return. Okay, so suppose we have here, we have return of security X, and then we have, let's say, return of security Y. Let me just name it as X and Y. So in the past 5 years, these two securities have, let's say, generated some amount of return, which we are trying to analyze. Okay, so let's say in the first year, this security X has generated a return of 12%, then a return of 13, then a return of 11, then a return of -8, and then a return of 14. Whereas the security Y has given us a return of, let's say, 13, 14, then a 10, then we have like a return of 3, and in the fifth year, we are having a return of, let's say, 9. So these are the two securities that we have. How do we get the expected return? How do we get the expected return and the risk of these two securities? Shall I use the probability scenario or historical scenario? Of course, historical scenario. So if I ask you what is the expected return and what is the what's the risk of the security? Let's compute that. For example, X and Y. We are looking for return and risk. Security X and Y, we are looking for risk and the return. So return can be simply computed by taking the average, right? You can simply compute the return by taking the average. So for that purpose, we'll take the sum of X values, sum of Y values. And of course, to measure the risk, we need to calculate the standard deviation. Now to calculate standard deviation, we need the one more column of for X, which is X square, and one more column for Y, which is Y square. So X square and Y square are the two columns that we need to take up. Now the standard deviation can be computed by taking the square of these terms, and standard deviation of Y also can be computed on a similar length by taking the square of these terms. Now you have the square numbers, you have all the numbers. Can you give me the return percentage and the risk percentage in these two securities, guys? I've already calculated the parts. The final substitution part is what you want to do. Give me the risk and the return numbers, guys. I'll give you a couple of minutes. Give me the risk and return numbers because all other calculations are placed on the screen. What is the return? I mean the expected return from security X and Y, and what's the risk that we have in security X and Y? Yep. Risk and return. What will be the risk and return, guys? So you can simply calculate the returns by taking the average, right? So return for A will be simply 42 divided by 5, which is 8.4. And for Y, it will be 49 divided by 5, 9.8. Right. So our expected return, we are expecting a rate of return from these two securities to be around 8.4 and around 9.8%. So return is 8.4 and 9.8. Now when we want to compute the risk, or what we call as a standard deviation, we can simply apply the square root thing. So it will be square root of, so for standard deviation of, let's say, x, this will be square root of 694 by 5 minus 8.4 square, right? So what is this number going to be? It's going to be square root of 694 by 5 minus 8.4 square. So that is 8.26. So risk for x is 8.26. Same way, what will be the risk for y? Risk or standard deviation for the security y. Calculations are also going to be again similar. It will be square root of it will be square root of 555 divided by 5 minus 9.8 square. So that gives us the standard deviation or risk of y to be square root of 555 divided by 5 minus 9.8 square. So we can say that the risk is 3.87. Risk is 3.87. Right? Did we get it, guys? Did we get these numbers? 3.87 and 8.26?
Yes, sir.
Yep. Okay. Now we have the numbers with regards to risk and return of a security. Suppose I want to create a portfolio of securities. Suppose I want to create a portfolio of securities, right? With obviously some amount of weightage. So let's say the weightage that we have for security X is suppose 60%, or I can say 0.6 being the weightage of X, and of course 0.4 being the weightage of Y. So we have already seen how to compute the risk and return of a security. Now we are targeting how to compute the risk and return, for a portfolio of securities. So if you look at portfolio of securities, suppose if I would have held this portfolio of both X and Y since the beginning, what would have been my portfolio returns? Tell me, guys. What would have been my portfolio return in the first year? If I would have held 40% weightage, where weight of X it is 0.6 and weight of Y being 0.4, if I would have held this portfolio security since the beginning, since the historical rate, 60% of my money is allocated in X and 40% of my money is allocated in Y. So what would be the portfolio return that we would be expecting in each of these years? In each of these 5 years, what would be the rate of return that would have earned? Can I say I would have earned 12 multiplied by 0.6 plus 13 multiplied by 0.4? Can I say I would have earned 12.4% return in the first year? Right, guys? Because if I have invested 100 rupees, 60 rupees has gone to X, 40 rupees has gone to Y. So 12% on 60 rupees and 13% on 40 rupees will give us this typical rate of return. Right? So I'm earning like a portfolio return of 12.4. I'm getting a portfolio return of 12.4. Same way, I can get the portfolio return for all the respective years also. So these are my portfolio returns. These are the portfolio returns which we would have earned if you would have created a portfolio 5 years back. Right? Now, if I ask you, what is the expected portfolio return? So in the upcoming years, what is the portfolio return that you are expecting? Expected portfolio return. Can I say, let's take a average of the historical portfolio return, right? So this is actually our historical portfolio return that we have computed. So historical portfolio return has been this. The expected portfolio return will be what? Just like in case of shares, the expected return was average of historical returns. Same way, expected portfolio return will be average of historical portfolio return. Right? Now, average of historical portfolio returns means it's going to be 44.8 divided by, of course, 5. So that will give us portfolio return. Expected portfolio return, overall portfolio return is going to be 8.96%. Right? Now, we got this expected portfolio return by simply taking the average of historical portfolio return. Alternatively, if you just try it out, just check if the weighted average of your expected return of X and Y, weighted average of expected return of X and Y, is it coming out to be same 8.96? Just verify, guys. Just check if the weighted average of these two numbers is working out to be 8.96. Just check. You can simply calculate this as weight of X multiplied by expected return of X plus weight of Y multiplied by expected return of Y. So if we do this, it should be ideally 0.6 multiplied by 8.4 plus 0.4 multiplied by 9.8.
It's coming, sir.
It's coming?
Yes, sir. Same.
Yes.
8.96 exact.
8.96 exact, right? So, can I say, sir, to calculate the expected return of my portfolio, will the historical return be required? No. It is sufficient if I know what is the expected return of individually X and Y. If I know that expected return of X is 8.4, expected return of Y is 9.8, and my portfolio is going to be created with certain weightage, I can simply take the weighted average and get the number as 8.96. So of course we can observe that both the numbers 8.96 are matching each other, right? So they are matching each other. So there is no what we say, other debate left as to which one is correct or incorrect. Okay, so both the methods, either you take the historical portfolio return and then you take the average, or you simply take the weighted average of the expected return. So the answer is going to remaining same. So in both the cases, we find that expected return is just one and the same. Okay, so 8.96, that's the same thing, guys. No difference at all. Now the idea is looking for the expected return risk of the portfolio. Let's compute the risk of the portfolio with the same method. So how do I get the risk of the portfolio now? Obviously, standard deviation of the returns, right? So in order to calculate the standard deviation of the return, Okay, this was, let's name it as return of portfolio. Now to calculate the standard deviation of the portfolio, we need to take the square of this, right? To calculate the standard deviation of the portfolio, we need to take the square of this term, right? So let us take return of portfolio square. So we can simply multiply it, right? So then you can check it is 602.64. Now I give you the task, guys. Please calculate the standard deviation using the formula. Please calculate the standard deviation, guys.
6.34, sir.
6.34. Standard deviation of the portfolio. Standard deviation of portfolio. Standard deviation of portfolio will be, can I say, we simply apply the formula as square root of summation of return of portfolio square upon n minus expected return of portfolio square. Okay. So if I just apply the numbers, it will be square root of 602.64 upon number of years is 5 minus expected return was 8.96 and we take a square of it. So this works out to be square root of 602.64 divided by 5 minus 8.94 square. That gives us 6.34. So 6.34 is the standard deviation of the portfolio. 6.34 is the standard deviation of the portfolio. Now, let's check the other method. Alternatively, can we apply this? Suppose weight of x into standard deviation of x plus weight of y into standard deviation of y. So this would be like 0.6 into standard deviation of x. What was the standard deviation of x? 8.26. 0.26 plus 0.4 into what is the standard deviation of y? 3.87. So this is like 0.6 into 8.26 plus 0.4 into 3.87. See? Do we see a difference now? Are we able to see a difference? Is the shortcut or alternative formula working in case of standard deviation? Is it working? No, there is a difference. Now don't discard this as some rounding up error, sir. No, we have already linked everything and it's not a rounding up error. There is a difference if we use the two methods. Okay, so here we are finding that 6.34, 6.50, there is a difference in standard deviation. It means I cannot use this formula, weighted average formula for standard deviation. I cannot use the weighted average formula for standard deviation. And therefore, our dear Harry Markowitz has given us some formula, which we'll discuss in the later stage. But the point is, this formula doesn't work. The weighted average formula doesn't work in our given scenario. Okay, so why it doesn't work, we'll get to know about it. But just to put up some suspense, let me take another case, guys. I hope we are clear till now with this calculations, whatever we have done. Like we are clear, like what is matching and what is not matching with regards to the numbers, right? Yes, guys. That both the methods are clear. That the shortcut method or the weighted average simply method, it works for expected return, but then actually it doesn't work for standard deviation. Okay, why it doesn't work and what is the reason? We'll try to understand in a short while. Let me take another case. Suppose we have here return of X, return of Y. Okay. So here 1, 2, 3. Let me just do it just for demonstrating you or to visualize you what we are really trying to understand in this typical topic. So let's say return of X was 10, then it is 13, and then it was, let's say, again 9. So return of Y is, let's say, it is 15. Okay. So let's say this is 21 and this is 30. So we've got two securities with their respective returns. So X we have like 10, 13 and 9, and Y is 15, 21 and 13. Okay. Now again over here, if I want to say what is the expected return of expected return, we can just say what's the expected return for X. We can simply take an average of it. Okay, we can take a average of this and this. Okay, so average is this. Now to calculate the standard deviations, of course we need to do X square and Y square. So let's say X square and the Y square, right? We take a sum of all the values anyways. Right? So these are the X square and Y square, and then I just calculate the standard deviation. So standard deviation of X and Y, I'm just computing it without writing any formula now, because I just want to show you something. Standard deviation will be square root of summation of X square divided by N minus the expected return square. Okay, so these are the standard deviation that we have. So it is square root of square root of summation of X square divided by 3 minus the expected return square. These are the standard deviations that we are getting over here. Okay. Yeah. So now if I ask you what will be the portfolio weightage, now let's say we are assigning weight of 0.7 over here and 0.3 over here, 70%, 30%. So I can get the return of portfolio. Return of portfolio will be weight of X into X and plus weight of Y into return of Y. So it will be like 0.7 multiplied by 10 plus 0.3 multiplied by 50. Okay. So this is return of the portfolio. Okay. So these are the portfolio returns that we have, the expected portfolio returns for each of the past years, historical portfolio returns. So now I'll take a summation of this. And if I look for portfolio return will be average of historical portfolio return, right? So if you're looking for calculating what is the expected portfolio return, we are simply taking the average of historical portfolio return, which is nothing but 37.1 divided by 3. Right? So we'll just take it as 37.1 divided by 3, which is simply 12.37. And as we have observed, just check whether the alternative works also for this. it should ideally work, which is like weight of x into return of x plus weight of y into return of y. So you can see that it is 0.7 multiplied by 10.67 plus 0.3 multiplied by 16.33. Okay, so if you look at the alternative thing, is it working over here? Like 0.7 into the return plus 0.3 into the expected return. Yes, it is working even in case of arithmetically. So I can say expected return method is very clear, sir. We can actually work around with this formula also, which is weight of x into expected return of x and weight of y into expected return of y. That formula is essentially working for us. So the shortcut is very much valid for this type of data when we are having, two securities and they are being taken as a weighted. So I need not require the historical return. Just if you give me the expected return, I can get it as 12.37, which is matching. Now, expected portfolio standard deviation. Expected portfolio standard deviation will be calculated as square root of return of portfolio square, or let me just write it. Expected portfolio standard deviation is calculated as square root of return of portfolio square upon n minus expected return of portfolio square, and then we take a square root of it, right? So if I apply this, let's say square root of return of portfolio square, which was 37.1 square, minus the expected return square, yeah. Some problem?
Return on portfolio should be squared, no, sir?
Yeah. I have to add that column. Yes. Return of portfolio square. Yeah. So this multiplied by the return of portfolio, and then we take a summation. So we get 473. So now I can apply the square root of 473.45 minus expected return square. Right? So we're getting this as this 1 divided by 3. Yeah, so we get this as 2.21. So portfolio standard deviation is 2.21% using the historical returns. Now just check, does the alternate method of just taking the weighted average of x multiplied with standard deviation of x plus the weighted average, weight of y multiplied by standard deviation of y, just check if it is matching with this.
Yes, sir, it is matching.
It's matching. So 0.7 into standard deviation of this plus 0.3 into standard deviation of y. Now it is matching this. So the idea is, sir, this shortcut formula, by simply taking the weighted average of the standard deviation, it is not matching. It was not correct in the previous case. But now in this case, sir, you have done some jugglery with these numbers. It is somehow matching this. Now, what is the reason for that? In one case, it is, this formula is working. In other case, this formula is not working, right? It is due to something called as correlation between the two securities. It is due to something called as correlation between the two securities. And that part, again, I leave it as suspense to you guys. We will discuss more about that correlation and its impact on the portfolio risk in the subsequent sessions. Okay. So how to calculate correlation? How is that correlation going to impact my portfolio, standard deviation? And whether it is going to increase my standard deviation, whether it's going to decrease my standard deviation. That is what is the discussion that we are going to take it up in the next lecture. Now, it's open to you. If you have any queries, you can ask. Yes, Abrakesh.
Good morning, sir. Sir, in this example of X and Y, while calculating standard deviation, we have taken straight away square of the value of individual value of X and Y respectively.
Correct.
Generally, in standard deviation, sir, are we not, deducting value of expected value from the respective value, then square it?
So you're talking standard
And
deviation. Say standard deviation
for calculating standard deviation of, say, for X.
Yeah. I am coming to that. Wait. So for calculating standard deviation, we generally use this formula, right?
X minus X bar
minus X bar.
raised to 2.
Correct. So when you use that X minus X bar formula,
so will it give same result, sir? I will try at home then.
Yes,
I will try it of my own.
So it's like
just I want to check.
Abhijay sir, you
Yes,
can
sir.
try it at your home and answer will be the same. Don't worry.
You're
okay, sir.
for
Thank
this
you,
formula,
sir.
right?
And
Yes,
in the
yes,
exam
yes,
also, sir, let me clarify.
Yeah.
In the exam also, you can
Yes, sir.
use either of the approach.
Okay. Thank you, sir.
Okay, because
That's
answer will be the
nice.
same. Answer will be the same in
Okay.
both the cases.
Sure,
You
sir.
try it at
Thank
the
you.
home. If the answer differ, please do let us know. Okay, sir.
Yes. Sure,
Okay.
sir. Thank you, sir.
So answer won't be different, Abrakesh, because it's just the derived form of that. Now, I would add that I would not recommend you to use this formula typically, because it's like X minus X bar, and by chance if your X bar is in decimal number, then the subtraction will be also decimal, the squaring will be also in decimal. So the calculation becomes a bit more difficult, and therefore
manually it become difficult.
Yes, so therefore we use this method.
Okay, thank you, sir.
Okay. Yeah.
There is one query by the student saying that, sir, you show the calculation on the calculator as the Excel is not available in exam. Student, please note that here we are showing only computation part on the Excel. Otherwise, you can do easily the calculation on your simple calculator, not even a financial calculator, or a simple calculator. So here our purpose only of using the Excel only to just simplify the calculation, and because it is taking lesser time. Okay, so because in the exam you have, of course, you will not be provided with the Excel sheet, so you can easily handle the same. Okay. Okay, sir. I think there are no more queries.
No more queries.
Okay, student. I think in today's class we have finished up the topic of security valuation, and after that we have started with the portfolio management. Now this session will be continued in the coming classes. So my request to you, please go through both the topics, and if you have any query, you can send us your query at our email ID. Just Bandhuji, just show my email ID, and you can contact me over the telephone as well. Zero 0120 3045 956. This is my landline number. Of course, today I am on leave. I will not be able to pick up your phone. But you can, on Monday, you can call me at this number, or you can, in between, you can send the email at sfm-final@ICAI.in. All in small font. Okay, just so all in is lowercase. So you can send me this, and thank you, Bandhu sir. for sparing your precious time and enlightening the student on these two topics. And thank you, student, for patient listening and giving your feedback. Of course, you are sending your queries, so it will also helping us to improving our classes, quality of our classes, and even study material as well. Thank you very much. Have a nice day. Thank you.
Thank
Yes,
you.
thank you.
Thank you.
Thank you.